Preparing for a compliance at JPMorgan Chase Co interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does compliance mean in a global bank like JPMorgan Chase? Compliance in a bank like JPMorgan Chase is about preventing regulatory, conduct, and reputational risk before it becomes harm. I see the role as translating laws and internal policies into practical controls, training, monitoring, and clear escalation. It is not just saying no, it is helping the business operate safely. In a global bank, that also means understanding cross-border rules, documenting decisions, and challenging activity that could affect clients, markets, or the firm. While answering, focus on compliance as risk management, not box ticking. Mention regulatory obligations, customer protection, market integrity, escalation, and balancing business enablement with independent challenge in a highly regulated global bank. Question 2. Walk me through how you would identify and escalate a potential AML red flag. I would start by separating unusual activity from suspicious activity. For example, repeated cash deposits just below reporting thresholds, followed by rapid wires to high-risk jurisdictions, deserve scrutiny. I would review the customer profile, expected activity, source of funds, transaction history, and any adverse media. If the activity lacks a reasonable explanation, I would document the facts, avoid tipping off the client, escalate through the AML process, and support any SAR decision with evidence. Make sure to cover the difference between unusual and suspicious activity, common red flags, customer profile review, evidence-based documentation, no tipping off, and escalation through the AML or financial crime investigation process. Question 3. How would you approach KYC for a new institutional client? KYC starts with knowing who the client is and why the relationship makes sense. I would verify identity, ownership, control persons, business activity, geography, products requested, and expected transaction behavior. Then I would risk rate the client and apply enhanced due diligence where needed, such as for PEPs, complex ownership, or high-risk countries. The key is not collecting documents mechanically. It is forming a defensible view of customer risk before onboarding. In your answer, talk about identity verification, beneficial ownership, expected account activity, client risk rating, enhanced due diligence, and why KYC protects the bank from money laundering, sanctions, fraud, and reputational risk. Question 4. A payment alert shows a possible sanctions match. What steps would you take? Sanctions risk is zero tolerance in practice because one missed prohibited transaction can create serious legal and reputational exposure. If a payment flags, I would first check whether it is a true match or false positive, using identifiers such as name, address, date of birth, ownership, vessel, or bank details. I would not release funds until cleared. For possible matches, I would escalate, preserve the audit trail, and follow blocking, rejecting, or reporting requirements. Be sure to mention true match versus false positive analysis. Identifiers used in screening, payment holds, sanctions ownership checks, audit trail, escalation, and blocking, rejecting, or reporting obligations. Question 5. Explain the 3 lines of defense model and where compliance fits. The 3 lines model clarifies accountability. The first line owns the risk because the business originates clients, trades, payments, and processes. Compliance is second line. We set policies, advise, monitor, test, and challenge independently. Internal audit is third line, providing independent assurance over both. In an interview, I would stress that compliance cannot replace business ownership, but it must be strong enough to challenge decisions and escalate when controls are weak. While answering, focus on first-line business ownership, second-line compliance challenge and advisory responsibilities, third-line audit assurance, independence, escalation, and why clear accountability matters in a large bank. Question 6. How would you manage a new regulatory requirement affecting multiple business lines? I would treat regulatory change as a controlled project, not an email update. First, identify the rule, scope, effective date, and impacted businesses. Then perform a gap assessment against current policies, procedures, systems, training, and reporting. I would assign owners, track actions, validate implementation, and keep evidence for regulators. At JPMorgan Chase scale, the challenge is consistency across regions while respecting local legal requirements and maintaining clear governance. Make sure to cover rule identification, impact assessment, gap analysis, policy and procedure updates, training, control implementation, evidence retention, governance, and regional coordination across a global institution. Question 7. What factors would you consider in a compliance risk assessment? A compliance risk assessment ranks where the firm is most exposed to regulatory or conduct failure. I would look at inherent risk, including products, client types, volumes, geographies, complaints, enforcement trends, and prior issues. Then I would assess control effectiveness through monitoring, testing, KRIs, and audit findings. The output should drive the compliance plan: where to review, where to train, where to enhance controls, and where senior management needs visibility. In your answer, talk about inherent risk, control effectiveness, products, geographies, client types, enforcement trends, monitoring results, audit issues, scoring methodology, and how the assessment drives the annual compliance plan. Question 8. What is the difference between compliance monitoring and compliance testing? Monitoring is ongoing surveillance to detect patterns or exceptions, while testing is a point-in-time evaluation of whether controls are designed and operating effectively. For example, trade surveillance alerts are monitoring. Reviewing a sample of closed alerts for proper rationale is testing. Both matter. Monitoring catches live issues, and testing tells management whether the framework is reliable, whether analysts follow procedures, and whether remediation is needed. Be sure to distinguish ongoing surveillance from periodic control testing. Mention alert review, sampling, design effectiveness, operating effectiveness, issue identification, documentation standards, and how both feed management reporting. Question 9. How would you investigate a market abuse or trade surveillance alert? Market abuse surveillance looks for behavior that can damage market integrity, such as insider trading, spoofing, layering, wash trades, or manipulation around benchmarks. If I reviewed an alert, I would compare the trader's activity against news, market movement, order behavior, communications, and prior patterns. A good compliance review is not just closing alerts quickly. It explains why the activity is reasonable or why escalation is required. While answering, focus on market integrity, insider trading, spoofing, layering, wash trades, alert investigation, communications review, trader patterns, escalation, and the importance of documenting rationale clearly. Question 10. How would you handle a gifts and entertainment request from a vendor or client? Gifts and entertainment rules protect independence and prevent the appearance of improper influence. I would check whether the item is modest, infrequent, business-related, properly pre-approved, and consistent with policy limits. Government officials require extra caution because anti-bribery rules can be stricter. If something feels designed to influence a decision, the safest response is to decline, document, and escalate. Perception matters almost as much as actual intent. Make sure to cover conflict of interest risk, policy limits, pre-approval, government official sensitivity, anti-bribery considerations, documentation, declining inappropriate benefits, and why perception matters professionally. Question 11. What is conduct risk, and how would you help manage it? Conduct risk is the risk that employee behavior leads to poor client outcomes, market harm, regulatory breaches, or reputational damage. I would manage it through clear expectations, training, supervision, surveillance, incentives, and consequences. A practical example is pressure to sell an unsuitable product to meet targets. Compliance should identify those incentives early, challenge the control environment, and make sure issues are escalated before they become client harm. While answering, focus on client outcomes, market integrity, employee behavior, incentives, supervision, surveillance, training, escalation, and how conduct risk connects to culture and reputational protection. Question 12. Tell me about a time you had to push back on the business or a senior stakeholder. I would stay calm and anchor the discussion in policy, facts, and risk. If a business partner wants to proceed despite a concern, I would explain the specific regulatory or conduct issue, offer compliant alternatives, and document the conversation. If the risk remains unresolved, I would escalate through the proper governance channel. The goal is not to win an argument, it is to protect the firm while keeping the business moving where possible. In your answer, talk about using facts and policy, explaining risk clearly, offering compliant alternatives, documenting the discussion, escalating unresolved concerns, and maintaining a constructive relationship with the business. Question 13. What is a suspicious activity report, and what confidentiality issues apply? A SAR is a regulatory filing that reports suspected money laundering, fraud, terrorist financing, or other suspicious activity. The most important rule is confidentiality. I would never tell the customer or unnecessary internal parties that a SAR is being considered or filed. My role would be to collect objective facts, document the rationale, escalate to the AML investigations team, and let the designated function decide whether the legal filing threshold is met. Be sure to mention suspicious activity reporting purpose, confidentiality, no tipping off, objective fact gathering, escalation to AML investigations, decision thresholds, record keeping, and why unnecessary internal disclosure is risky. Question 14. How would you perform enhanced due diligence on a high-risk customer? Enhanced due diligence means going deeper because the client presents higher risk. For a high-risk customer, I would verify beneficial ownership, source of wealth, source of funds, business purpose, expected activity, adverse media, political exposure, and jurisdictional risk. I would also consider senior approval and more frequent reviews. The decision should be risk-based. We do not reject every high-risk client, but we need a clear, documented rationale to onboard or continue the relationship. While answering, focus on high-risk indicators, beneficial ownership, source of wealth and funds, adverse media, PEP screening, jurisdictional risk, senior approval, periodic review frequency, and documented rationale. Question 15. Why is beneficial ownership important in compliance reviews? Beneficial ownership matters because criminals often hide behind shell companies, nominees, or layered structures. I would identify the natural persons who ultimately own or control the entity, not just the legal entity name. If ownership is complex, I would map the chain, verify documents, and understand why the structure exists. Where information is inconsistent or opaque, I would escalate because unclear ownership can indicate AML, sanctions, tax, or corruption risk. Make sure to cover natural person ownership, control, shell companies, layered structures, verification documents, ownership thresholds, opacity red flags, and links to AML, sanctions, tax, and corruption risk. Question 16. How would you show JPMorgan Chase's values in a compliance role? I would connect my answer to risk discipline and client trust. For example, in a prior role, if I found a documentation gap near a deadline, I would not ignore it to make the numbers look clean. I would flag the issue, explain the impact, propose a fix, and track remediation. That shows integrity, ownership, and respect for controls, which aligns well with JPMorgan Chase's emphasis on doing first-class business in a first-class way. In your answer, talk about integrity, ownership, control mindset, escalation, client trust, and JPMorgan Chase's culture of doing first-class business in a first-class way consistently. Question 17. What compliance risks arise when handling client or employee personal data? Privacy compliance is about collecting and using personal data lawfully, securely, and only for a legitimate purpose. If I handled client data, I would follow access controls, data minimization, retention rules, and cross-border transfer requirements. I would also be careful with emails, shared drives, and reporting extracts. In a global bank, privacy failures can become regulatory, operational, and reputational issues very quickly. Strong controls preserve client confidence. Be sure to mention lawful purpose, data minimization, access controls, retention, cross-border transfers, secure communication, need-to-know handling, and the regulatory and reputational impact of privacy failures. Question 18. How would you remediate a compliance issue found during testing or audit? A good remediation plan starts with root cause, not just fixing the symptom. I would define the issue, impacted population, regulatory risk, owner, target date, interim controls, and validation approach. Then I would track progress with evidence and escalate overdue or ineffective actions. Closure should require proof that the control now works. Otherwise, the same issue will reappear in an audit, regulatory exam, or future incident. While answering, focus on root cause analysis, issue ownership, action plans, target dates, interim controls, evidence, validation, escalation of delays, and proving sustainable remediation before closure. Question 19. What compliance metrics or KRIs would you include in a management report? Useful compliance metrics show whether risk is increasing and whether controls are working. I would track items like alert volumes, aging, false positives, overdue KYC reviews, sanctions hits, training completion, policy breaches, complaints, and repeat issues. But metrics need interpretation. A drop in alerts could mean lower risk, or it could mean a broken feed. Good reporting combines data, trend analysis, root cause, and clear management actions. Make sure to cover risk indicators, control effectiveness, alert volumes, aging, overdue reviews, policy breaches, training completion, complaints, trend analysis, data quality, and management actions. Question 20. Why do you want to work in compliance at JPMorgan Chase? I am interested in JPMorgan Chase compliance because the role sits at the center of trust, regulation, and business execution. The firm's scale means compliance work has real impact across products, jurisdictions, and clients. I like roles where judgment matters, interpreting rules, challenging risk, documenting decisions, and partnering with stakeholders. I would bring attention to detail, calm escalation, and a practical mindset that protects the firm without losing sight of the business. In your answer, talk about scale, regulatory complexity, client trust, independent judgment, partnership with the business, attention to detail, escalation discipline, and alignment with JPMorgan Chase's values. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.